Hello, we are on Life Insurance Section 1, page 1 of your study materials. Types of policies is the first section of our study book. It is important for life insurance to understand the basics of how policies work, and that is what we are here to discuss. The book is written in an outline form to follow the outline as published by Promisor. So what is in the book is what is on the outline for your test in your state. I promise I won't read to you. You can read. I am here to draw you stories, to discuss how the policies work. I like to draw a lot of charts. I'm a very visual learner myself, so that you can understand exactly how these policies function. So we will start at the beginning, types of policies. Traditional whole life. You must know that I've been around life insurance my whole life. My parents started training insurance agents and stockbrokers when I was 2, so I have literally been doing this forever. But I never thought much about life insurance until I decided that I would get married a week before I graduated from college. We decided, my husband and I, to move from Arizona to the state of Colorado, and we did that and found out 3 days before we moved that I was pregnant with our first child. We moved to Colorado in the winter, January 3rd. My husband had never driven in a snowstorm. He grew up in Tucson, Arizona, and I thought, oh my gosh, he's going to die in a car crash and leave me all alone with this little baby and a house payment, and so we got some life insurance. Life insurance is protection. Life insurance is not a retirement account. It's not a retirement plan. Life insurance is protection in case something was to happen to my husband. Now, there are different types of policies that we need to understand. And we start off with the very first policy that was invented, and that is called traditional whole life. Traditional whole life. Whole life is a type of life insurance policy that provides you with permanent protection. Permanent protection. It insures you for your whole life, just like it sounds, hence its name. Your whole life, according to the mortality tables developed by actuaries, will last until you are age 100. So there's an important point for all whole life policies. They provide permanent protection from the time in which you buy the policy, which is called your original age, until you die or until you reach the age of 100. So whole life is a type of policy that provides protection for your whole life. So let's give an example. Let's say that you decide to buy a policy at the age of 30. The age you are when you purchase your policy is called your original age. You will go through underwriting. You will have to pass a physical. Your premium will be based upon your age, your gender, your health, your hobbies when you buy the policy. So if you buy the policy at age 30, when you have a desk job, but at age 35 you decide to become a professional stunt pilot, they cannot change your whole life premium. It is fixed. So the premium for whole life is a fixed premium. It's based upon your original age. Now, how much protection did you buy? Let's say that you bought a policy with a face amount of $100,000. You are going to pay a premium every year for the life of the policy. So this premium is fixed. How often you pay your premium is called mode of payment. Think about your car insurance. The more frequently you pay it, the more or less expensive. What does it ultimately end up being? More expensive, of course, because of service fees. So what allows an insurance company to charge service fees? Mode of payment. I would like you to assume, for purposes of the test, that the premium is paid on an annual basis. Now, you're purchasing, in my example here, a $100,000 policy. That is your face amount. It's sometimes called your death benefit or your policy proceeds. All mean the same thing. And let's say that your annual premium is $1,000, $1,000 a year. Will that ever change? No, nothing can ever change your whole life premium. So you pay $1,000 a year. Now this is a type of traditional whole life called straight, or sometimes they refer to it as ordinary whole life. What that means is that the premium payments are paid every single year from the original age for the life of the policy until you die or you reach the magic age of exactly 100. So permanent protection. If you pay in $1,000 when you're 30 and you die at 31, how much will the policy pay? $100,000 to your beneficiary, tax-free. Life insurance policy proceeds are always tax-free to your beneficiary. That's important to understand. What if you died at, let's say, 65? How much is paid out? Still $100,000. What if you died at 99? How much is paid out? $100,000. Taxable or tax-free to your beneficiary? Tax-free, of course. Life insurance policy face amounts are tax-free to your beneficiary. So traditional whole life, it has permanent protection, plus it's going to have a growing cash value. So whole life is a cash value policy. So we need to understand how that works. There's an important rule for whole life policies. In the beginning years of the policy, there is no cash value. So for the first 3 years is a general rule of thumb. So here you are at age 30. You pay in your $1,000 a year during the first 3 years. You have no cash value. So you cannot take out a loan against your policy unless you have a positive cash value. So can you take out a loan at 31? No, but what if you die at 31? Do you have protection? Yes, of course. Now over time, exactly what your cash value is guaranteed. So pretend I can draw symmetrically because I can't. But exactly what your cash value is going to be at every age. When you purchase your policy, at the back of your policy, it has a table of guaranteed cash value so that at each specific age, you know exactly what your cash value will be. Because cash value on whole life is made up of two things. The first thing that it's made up of is the premium. Now, let me ask, is the premium going to change or is it fixed? It's fixed. Now, what do they do with your premium? They put it into the insurance company's what's called general account. Anytime your premium goes into the general account of the insurance company, it has a guaranteed interest rate. So I remember general account has a guaranteed interest rate because they both start with G. That just helps me remember. So this guaranteed interest rate, the insurance company takes your premiums and invests it conservatively in things like bonds and preferred stock. And they promise to pay you usually around 4%. So for purposes of this class and of this test, we will assume that the interest rate in the general account is 4%. So they take your premium, which is fixed, put it in the general account, and that goes into your cash value, plus interest. And do you know exactly what the interest is going to be over time? You certainly do, 4% in this traditional whole life policy. So they could ask you on the test, who has the risk in the general account? If the insurance company should earn 12%, what do they have to pay you? 4%. Of course, they make their money there. What if they only earned 1%? How much would they have to pay you? 4%. So that the insurance company has the risk in the general account. But I want to make an important point that I haven't done yet. There's a couple of very important terms that we need to feel comfortable with. I just said that the insurance company has the risk. The term that they typically will use on this test is insurer.